new textbooks and also replaces old ones at the beginning of every term for 650,000. Number 10, the school provides meals to staff and students at an average cost of 1.5 million per month. This is catered for in the school fees and capitation. The amount reduces to 40% when the school is closed. Number 11, electricity and water bills average 150,000 per month and 50,000 when the school is closed. Repairs and maintenance also amount to 250,000 per month and reduces to 40,000 when the school is closed. Number 12, the school plans to buy additional learning and staff equipment worth 1.5 million in January and replace old furniture at a cost of 2 million. In May, the old furniture will be scrapped at 200,000. Number 13, the school has a loan for which it will pay annual installment of 2 million and interest of 200,000 in December. Number 14, the school estimates that it will have cash balance of 5.5 million on 1st January 2025. Required: prepare a cash budget for the year ended 31st December 2025 on a month-by-month basis and also for the whole year. So what we're going to do, ladies and gentlemen, we are going to move towards the right here as usual, and then we are going to now bring forth or break down in form of an analysis per month what we'll be talking about, what Form 1, the number of students, and also and the fees that are going to be paid per student. Let's dive right in. So here we have January like that. And we are saying we are preparing for which year? For this as a 31st December 2025. So we will begin by January. So just come over here and say Jan hyphen 25. And then February hyphen 25. Not like that. We're just going to say, we're going to put Jan 25. That. Then you're going to put Feb 25. Feb 25. That. So when you have Jan 25, so it's not following through like that. So we come over, we just, what we do, just come like this. Jan 25. That. So this is what I'll do. I'll come to custom, come to more number formats, and I'll look at just the year. I'll look for the year and the month. This is day, month, year. This is day and month. I want the year. So we scroll down here. Over here. Not 1st Jan, not so we just talk about 31st Jan 2025. So we're just going to talk about the end of the month. So you're going to talk 31st Jan 2025. Then here we talk about 28 or 29 days 2025. So 2025 is not divisible by, is it divisible by 3? So it should be a leap year. 2025 should be, is it a leap year? So 20, so what, how you just determine is that 2025 over 3 over 4. It's not divisible by 4, so just delete that. So talk about 28 Feb 2025. So you're just picking the end of months. So it's not 31st March here. Now it's picking now the way I want, the way I wanted it to pick. So I want to go all the way to December. Let's see, when I highlight like that and just express it like that, expand it, that. First 2025. So once we have that, then we can then proceed on to look at the information that is given to us over here. So we're talking about we'll need to analyze point number 1 over here together with the fees. So point number 1, the school estimates it will have 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, and 100 students in Form 4. The Form 1s will report in February 2025. So here, we've not been told. I'm just preparing this as at the end of the month over here, but we're saying that obviously if they report in first, it's the 1st of February 2025 over here. So allow me to use just that format over here. So I may need to put it in that format like that. Allow me to put it in that format so that now it can at least be much better, give better visuals here. So now we're saying that the number of students, we can just analyze over here number of students over here. The number of students, and we're saying that we'll create a gap right over here, insert, right over here. And the number of students will have to type Form 1 through to Form 4. Form 2, like that. Form 1 to Form 4. And then we'll also need to analyze the fees per student. Fee per student. So just maybe perhaps insert here. Just drag it down here. Fee per student. So I'll just copy this right over here. So copy and just put right down over here like that. And once we have that, then we go to the information or the details that relate to the budget preparation. The school estimates 120 students in Form 1. So here we are told 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, 100 students in Form 4. But we've been told that Form 1s will report in February 2025. So what happens is that when we come to this information right over here, we are saying that Form 1, there's nothing to do with January right over here. We'll expect 120 students there in February. And also in March, we'll also expect 120 students in March. For Form 1, that is. So because we've been told that the 120 students Form 1s will report in January 2025, we will now proceed on to see when the months actually, the term dates actually are. So we move on to the beginning with the 3 terms commencing January, May, and September. So we'll do the same for May over here. So here is going to be, of course, the holiday. So we'll proceed on to put 120 students. And June, 120. That. So in July, we're not going to have them. August, we're not going to have them, because this is going to be the holiday. So September and October, we're also going to have the same students. So we're saying that with the 3 terms commencing January, May, and September. So September, so you said now we go to September. So this is May and the September. So 120, 120. That. Let's just make sure that the Form 1s will report in February, following the fee structure that is payable parents per term. So now let's analyze, first of all, we finish off this part in part 1, or this segment that relates to part 1 over here. So 120 students in Form 1. Now we do 110 students in Form 2. And those ones come in January. So Form 2, 110. And also in February, 110. There. In March, we've not been given any information about March, right over here. So we will do the same also for the semesters in May. So here, it's going to be 10, 10. Here is 10 and 110. 110, 110. Form 3s, let's see, they don't have an issue for Form 3s. 100 students in Form 3 and 100 students in Form 4. So the same for Form 3 and Form 4. Form 3 is 100 and 100. That. So we just drag those ones like that. And then here we put in 100 and 100. And then over here we put in the same. Like that. Now let's analyze the fee per student. So the school estimates 120 students. This one we've analyzed. The following fee structures is payable by the parents per term. 33,500 in Form 1, Form 2, 36,500, Form 3, 43,500, Form 4, 45,000. So we are saying that in Form 1 is 33,500, but we are saying that they join in when? When do they join? They join in February. So per parent per term. So here we have 33,500. Like that. And here we have 33,500. Per term. Let me just understand that. The following is the fee structure that is payable by parents per term. Like that. Parents are usually paid 60% of fee when the school opens, and the balance at the beginning of the next month. So here is 33,500. That is going to be like that. And you are saying 33,500. Let me just put it like that first. And then for Form 2, we are saying is going to be how much? Here is the information. 36,500. And you're going to do it over here in January. 36,500. That Form 3 is going to be 43,000. Here's Form 3, 43,500 and 45,000. 43,500 there and 45,000. Like that. Then we are saying that this information is going to be done the same now in May. Over here. Let me just confirm one thing. The parents are usually paid 60% when the school opens, the balance at the beginning of the next month. Over here. So here, the school opens in May. Over here, we expect it to pay the same. So in May, it's just going to be that value. And then this one is just going to be that value. That. Just drag it down. Drag it down like that. I'm just putting the fees, the total fees when they're supposed to be. The breakdown will actually be done when we create the cash budget. This is just the preliminary information that I'm just putting over here to at least make sure that this information is broken down and synthesized easily. Now let's go to the September semester, or the September term rather. So here we're saying it's just going to be 33,500, that one there. It's going to break it down like that. There. So now, once we have that, then let's prepare the cash budget, because what we've been informed right here down, prepare a cash budget for the year ended 31st December 2025 on a month-on-month basis, and also for the whole year like that. So this is the preliminary information put right over here. We will be able to break it down like I've just mentioned earlier on. So I put the comma format and then 2 decimal points like that. That's what I need. Show the cash budget. So here we come cash budget. Cash budget will have the receipts and will have the expenditure or the payments there. So the cash budget begins by looking at the years, of course. That, shift to their control R. And then, because we are seeing that these ones are going to be in thousands, like that. Center like that. So put these ones also like that until December. Thousands. And then we start it out. Balance at the beginning. We've been given balances that are supposed to be there at the beginning. So balance at the beginning. At the beginning. Put it in the short form like that. And let's look at it together. This is the electricity and water bills. The plans to buy additional, these are the information that's right over. The cash budget is what we've been told to create. The school estimates to have a cash balance of 5.5 million, like that. So once we have 5.5 million as on 1st January 2025, we can just come right over here and say that here, because it's in millions, 5,500. That's at the beginning there. And this one is, of course, note number 14. Please let me just put it note number 14. Let me just allow me to put it maybe somewhere just beside it over here. I can just insert here, insert, so that I cannot perhaps become mixed up. This is note number 14 over here. Or I don't have to do it like that. I can just put inside a comment, insert a comment, insert, right click, I right click over here, insert a comment over here and say note number 14. Note 14. That. So that when you hover like that, you can see it's note number 14 there. And then once we have that, we now analyze now the receipts right here. Receipts. Control B. And you're seeing that the receipts, we'll start by saying the fees right over here, fees. Like so. And we start by putting from Form 1 through to Form 4. So copy. Like that. And we can see that for Form 1, we don't receive it in January. Why? Because they join at this point over here. So Form 1, we are saying they join in February. And we are saying that we will need to first of all pick, saying that the school estimates it will have 120 students in Form 1, 110 students in Form 2, 100 students in Form 3, 100 students in Form 4. The Form 1s will report when? The month of February 2025. So we will pick the 120 students times this fee, but it will not appear in January. It will appear when? In February, when they actually join over there. Additionally, we need to also consider note number 2. The parents are usually required to pay 60% of the fee when the school opens and the balance at the beginning of the next month. That is, Form 1s pay 60% when they report in February and 40% in March. So, what I'll do, I will pick the fee, which is 33,500, and multiply that with the number of students when they join. And then I'll multiply 60% because you're supposed to pay 60% times 0.6, which represents 60%. And because I want it in terms of thousands, why? Because I've put that in terms of thousands, I divide by 1,000. That's what I get there. Now the balance of 40%, this is 60%. You can see it's 60%. The 40%, Why I'm putting the 120 over here, students will still be in March over here. They will still be there. So if I drag it across, I drag, or I do it like this. I pick 33,500 and I multiply with the number of students there, which will still be in March. I'm saying because they joined in February, times 0.4, that's the 40%, divided by 1,000. I get that. That is the balance fee that they're actually being paid over there. So I don't need even to have this column over here. So just delete it, that there. Even these ones, we may not necessarily need them right over here because they're just going to be the students when they join, like over there. So I just deleted those ones over there. I was just putting them over there so that now I can be able to see maybe, or in terms of computation, how I'd be able to compute them like that. This is when the Form 1 students join. So we can be able to put over here that, the comma format, that Form 2. We do the same. Form 2s join in January, there. And we are saying what for Form 2s? Let's see. Form 2s are 110 students, Form 2, 100 students in Form 3, 100 students in Form 4. Form 1s join report in February 2025, that's okay. So Form 2s have got 36,500. Parents usually pay 60% of fee when the school opens and the balance at the beginning of the next month. But Form 1s is the same, so required to pay 60% of fee the school opens. So that's it. We just do the same for Form 2. I will pick Form 2, the fee per student. I multiply that with the number of students there. And then I multiply by 60%, 0.6, it requires 60%. And then I divide by 1,000. That. So that's what I expect to have from Form 2. So if I do it like that and I perhaps just drag it down like that, there'll be no harm. But here we're saying that we'll expect now 40% now. Here is 60%. You can see it's from here, from the formula bar here. Now I'm saying 40%. So I'll pick for Form 2 the number of students. I multiply that with the fee per student, that one there like that. And then I multiply by 40% and I divide by 1,000. That's what I get. So if I drag it down, there'll be no harm. Like that. And we can be able to do that for the same periods right over here. Or for the May semester. June, we don't expect to still have, we still have the number of students remaining like that, to be the same. I was putting it so that it can be able to ease in the process, but now, ease in the computations rather, but now I can just delete them like that. So once we have that, then we are saying we expect to have the same computations for, for the May semester or May term, and also for the September term. So putting it all together over here, I just copy this, it will pick with the formulas, copy. I come to the May term right over here. You can see it's like that. And then I pick these ones over here, it will pick copy. Just come right over here. It will pick. It doesn't change much. Because I'm saying I'm picking the number of the fee per student times the number of students for Form 2. It's not expected to change. And so if I pick this the same, it should actually essentially be the same, because the students are going to come in June. Right there. So I pick, I'll put 120, so I'll need to put that there, and then over here the fee should be 33,500. This should actually be right here, like that. So, undo, apologies for that. I'm just saying that the 60 this is 60%. So the 40% should be based on the same. So I can just pick, I don't even need to put the 120 right over here. You're paying 60% and 40%. So it's just going to be for Form 1, that value times that, which is the number of students, times 0.6 divided by 1,000. Not 0.6, excuse me, 0.4. The 0.6 is covered over here. You can see the 0.6 is here, 60%, and here is 40%. And then we are saying that now the 40% be covered like that, and so if I drag it down like that, it should be able to come those values like that. Moving along, just maybe perhaps condense this by double clicking it like that. The other semester, the other term, excuse me, is right here. Just copy this, it copies the formula. Right here, the September formula, that. Because you're saying we're going to pick the 36,500, so it's going to 2412, right there. And then 2409, and then 2610, 2700 there. Of course, these ones will also copy the same from above there like that. Why? Because I'm picking 40% of that one times that one divided by 1,000 there. We will need to also have a total right here, total. So drag this across like that. Copy cells, I just want it copied. Bold. And so here, what I'll just pick is the sum of all of these values here, from January through to December. Close the brackets, enter. So the fees that are going to be collected for each month, or for each year, is 12,060, yes. And then I drag it down all the way like that, like so. So let's move on. Still under receipts, analyze the fees. These are all fees, receipts. Let's see what else we've been given. So in terms of the fees, we have analyzed that information right there. Allow me to put it in maybe a very faint color, like so. That one we've analyzed. We've also analyzed this information that's right over here, where the parents were supposed to pay 60% of the fee when the school opens, and the balance remaining months, which is 40%. Note number 3 here. We talk about capitation. So let's highlight that. The school receives capitation of 16,000 per student per term, which is received at the beginning of the term. And so we are saying the 16,000 will be based on, we want to calculate it based on the number of students. The Form 1, Form 2, Form 3, and Form 4 students each receive 16,000. So we can say over here, capitation, right over here, and I'll pick all the students, Form 1, not the fee per student, the students. That plus that plus that plus that. And then I multiply that by 16,000. And then I divide by 1,000. Why? Because we're expressing it in terms of thousands here. That value should be placed in the month of January. Right there. Put it like so. Why? Because we are told the school receives capitation per student per term, which is received at the beginning of the term. It's received in January, month of January, right over here. This should be boldened. This should be boldened, Control B. So that's what they receive. They also receive, so copy. So I'll also do the same for this term right over here. Put the brackets for all the students. Plus that times 16,000 over 1,000. It's the same. This is the same as that. So that format painter come there. And I can copy this as well for the September term right there. Like that. Nation 2.5 million per month, but this reduces to 60% when the school is closed. So we come over here, donation, down over here, donation. And we can come right over here and say that the amount was how much? On average, 2.5 million. So it's 2,500. I can put 2,500. That per month. Did you say per month? Just to confirm. Per month, but reduces to 60%. Yes, it's per month. So it's going to be correct. Like that. And then can pick plus that value and reduces to 60% times 0.6. Yes, like that. And then it returns back again to that one there. So it comes back to 15% during the August holidays. You can see the August holiday here. And then we drag it to the December semester 1,500 like that. So 25, 25, 25. This is the December holiday there. This is the August holiday. Returns to 60%. And this one comes to 60%. That's fine. Still part of the receipts. Let's analyze another receipt if we have. The school has a small farm from which it generates harvested produce. It is estimated that the produce generates 200,000 per month. There's nothing else we are told whether it produces or anything, so it's all year round. 200,000. So harvest, sale of harvest, that. So here we're in January, so 200. Remember, it's in thousands here, so 200,000, so it's 200. That, and it's all year round up to December. 200. Do we have any other receipt? In addition, the school hires a bus every weekend for events earning 60,000 per month, except in December when the bus driver is on leave. So here we highlight it and say bus hire income. Excuse me, I need to see how much it was. 60,000. So just put 60 here. Not until December. No, until November. Until November. December, we've been told driver will be on leave. So we are saying, of course, these ones are also going to be totals. We're talking about the totals right over here. like that. So it picks everything from there. So all the totals. Let's see if we have any other income. The school pays, that's an expense. The school spends, that's okay. The school buys new textbooks, that's an expenditure. The school provides meals to staff at average cost, that's an expenditure. Electricity and water bills, expenditure. The school plans to buy additional learning and staff equipment worth 1.5 million and replace the old furniture at a cost of 2 million in May. The old furniture will be scrapped. This is a scrap value right over here at 200,000. So the scrap value, the 200,000, should be an income to the school. And which month should it be placed on? It should be placed in the month of May, in May. So the old furniture will be scrapped at 200,000. So in May, we can just put sale of furniture. But here you're seeing May is where, right here we just put 200 like that. And then we have any other income? Let me just confirm. So here I'll just highlight just this part here. Allow me to highlight just this part. With your permission, just do that. The school has a loan, that's okay. The interest is going to be an expense. The school estimates that it will have a cash balance of 5.5 million. That one we've already factored in. So we'll need then to look at total receipts right here. Total receipts, and we can put it. We can bolden this. Control B, like that, right over here. And we're seeing total receipts. Sum from here. So I'll need to put it like that, and then I reduce it. That, so I just put Control R. Those are the totals that I expect. Over here. So once I see that, I can say that I'm happy. Just going to go and double check each and every item, and once I finish off the expenses right there. So of course I'll just need this to be in this format, all of this to be in that format, like that. Yes, that's what I expect it to look like. So that's total receipts over here. And so with these total receipts being computed or having been computed, then of course we can put it now the double underline, come up over here, look it like that. Let's analyze the payments right down over here. So payments, the payments here can start off from the top as we come down. So from the top here, the ones which are highlighted are incomes. The school pays on average salary. So we start with this one over here. Right over here. Allow me to use a different color, please, with your permission. So that one, maybe you can put it like that. Yes, that should represent costs, payments. And we say the school pays on average salaries and wages of 6.2 million per month, even when the students have closed. So salaries and wages. So let's go step by step. So we are saying the amount was 6.2 million. So you can put 6,200 over here. That 6,200 and drag it across. Sum of all of these values. So just looking at. Yes, once we have that, then salaries and wages, we can move on to the next item. School spends 550,000 on general consumables, which reduced to 60% when the school is closed. So we highlight that. That's also our payment cost. We can term it as general consumables. General consumables. 550,000, 60% when schools are closed. 550,000. So here we can talk about 550, like this, and then 60% times that. So we're talking about 330, and then it comes back again over here, like that. Drag it to the end. Here we are saying we have that value like that. That's total. You can drag it all the way down here. Next payment that we have to analyze, number 9. The school buys new textbooks and also replaces old ones at the beginning of the term at 650,000. So at the beginning of every term. Highlight that. You can see textbooks. Is there any other item? Textbooks. The textbooks replaces old ones at the beginning of the term at 650. Yeah, 650. So it's just 650 at the beginning of every term. So 650. So we talk about May 650. And then you are saying we'll go to September 650, like that. We're going to 1950. Analyze another payment. The school provides meals to staff and students at an average cost of 1.5 million per month. This is catered for in the school fees and capitation. The amount reduces to 40% when the school is closed. So we talk about 1.5 million. We talk about food and drinks or foods. Here, 1,500. 1.5 million. We're saying it's 50 per month. 1,500 per month, and you can see it's per month. Per month, yes. 40%, it drops down to 40% when the school is closed. So here we have that, and then we say 40% times that value. So it comes back again now when you talk about May, like so. Drive it to the end. That is food. So that one can be highlighted as done. Number 11, electricity and water bills average 150,000 per month and 50,000 when the school is closed. Repairs and maintenance also amount to 250,000 per month and reduces to 40% when the school is closed. So you can just do electricity and water and repairs and maintenance. So just come over here. Electricity and water, copy, and then I come to repairs and maintenance. Repairs and maintenance, I come right over here and copy this. There. So electricity and water, 150 per month. 50,000 when the school is closed. So 150 per month. So 150,000. It's 150. Here we also have for the 3 months 150,000, and then 50,000 when the school is closed. 50. So I copy it so that now it can just follow through in that order. And then for the repairs and maintenance, Just highlight that one there. Repairs and maintenance also amount to 250,000 per month. It reduces to 40% when the school is closed. So 250,000. Repairs is 250 per month. And reduces to 40%. 40% times that value is 100. So I want it to be in that order. That. So I talk about the repairs and maintenance. So because January, February, March 100, April, May, June 100, and then 250, 250, 250, 100. So that goes to 2550. Okay, so once we've had that, then we're saying that we will need just to analyze the repairs when the school 250 per month and reduces to 40,000 when the school is closed. Okay, just wanted to check whether in April 100, August it's 100, and in December it's 100 there. It's okay. Any other cost or payment? The school plans to buy additional learning equipment, or purchase of equipment worth 1.5 million in January and replace the old furniture at a cost of 2 million, like that. So we're talking about purchase of equipment. Have we been told which month? Yes, additional learning staff equipment of 1.5 million in January. So that's a cost. And we can say purchase of equipment right here of equipment purchase of equipment, and we are saying right over here it's going to be 1,500. Yeah, 1,500 in January. So here you put 1,500 like that. Perhaps I can be able just to squeeze it up a bit. Yeah, like that. So once we have it like that, then we're saying we can then proceed on to purchase of equipment. What did I do here? I think I must have dragged it down. Yeah, so it's not supposed to have been dragged down like that. Here. Purchase of equipment, 1,500 in January, and replace the old furniture at a cost of 2 million in May. So in May, here, where is May? We should put 2 million or 2,000, because we're saying we're expressing it in terms of thousands there, that. And then these values should be, of course, like that in May. So this one should now then total should actually be now in beige. Is there any other cost? Number 13, the school van. The school has a loan for which it will pay annual installment of 2 million and interest rate of 200,000 in December. So we come to loan repayment. Loan repayment right here. And you're saying when you have the loan repayment, it will be paid. The school has a loan for which it will pay the annual installment of 2 million and interest of 2,000 in December. So that's the loan repayment. So here you should be able to specify principal. And here interest. So here, the loan principal can come right over here and put it as 2,200,000 and both in December. It's going to be 2 million. Loan principal, is that principal? Yes, 2 and 200,000 like that. Like that. So let me analyze and see if there's anything else that we have. School estimate, it will have a cash balance of 5.5. This one has already been factored in right over here. So we'll need to then analyze the total payments. Total payments, this can be boldened. Over here, Control B, can be put top and bottom border like that, and can be dragged up there like that. But here as sum of what? All of these payments up to down here. Close the brackets, enter, and then we drag it across like that. So this one, of course, was the total moving across like that. It should not be boldened. That. So we're talking about, so the total here, and you can see it's 107,340, should be the same as this one moving across like that, 107,340. So just pick sum of all of those. It doesn't matter which one, which side they go. 107,340. So we'll need then to move ahead and analyze the balance as at the end. As at the end over here, we will take, of course, the total receipts minus total payments, but we add the cash at the beginning. So what I mean is this: I will pick cash at the beginning, this cash at the beginning balance, which was given to us over here. We add the receipts, and then we less the payments, so that we can be able to see how much we have right there. Balance at the end. This balance at the end becomes the balance at the beginning right over here. So for February, balance at the beginning should be the balance at the end right here. So put it like that. That. And I can be able to just drag it across like so, up till there. And because this one has got a formula, just drag it across till there. And with that, we can then say that now we will also need to pick, these values here can be spread out like that. Yes. This is the balance. Yeah, so we pick the balance at the beginning, we add the receipts, and then we subtract balance, then we subtract the total payments right over here, and then we get this one, it comes up right over here. With the balance at the beginning right here, we add the receipts, and then we less the payments right over here, we get negative 285, that. So if I just drag it across like that, and this one I drag it across like so, you can see this is the total balance that actually have right over here. And with that analysis, we can say that actually we've overdrawn our account by 6,270,000, like that. Thank you for being with Manifested Publishers. We hope that you've enjoyed this question 23, Business and Data Analytics for the December 2024. Thank you for being with us.
Welcome to Manifested e-learning platform. We continue with our series on tax planning. Today we are handling a question in September 2021. That is question 4A. We'll read the question. Describe a tax planning opportunity that could be derived in relation to financial management decision in a company. Describe tax planning opportunities that could be derived in relation to financial management decision in a company. So what are the various tax planning opportunities that are available for a limited company? We need to understand that tax planning we defined before. Tax planning refers to, we say it refers to the arrangement of the taxpayers, affairs in such a way to reduce the tax payable to the Kenya Revenue Authority, which is KRA. We'll say without contravening the law. So when you talk about tax planning, and for this particular question is tax planning for a limited company, we are talking about ways in which a company can reduce the tax payable to the government in such a way that they do not contravene the law. And when you talk about contravening the law, we are basically saying going against the law. What are these opportunities? The available opportunities basically includes, we can discuss those opportunity. We talk about what we call insurance. We talk about what we call voluntary tax disclosure programs. This was a program that was there until 2021, when the government through the KRA was basically disclosing that if you disclose your tax arrears within those periods, then you'll be given a waiver on penalties and interest. So the government can also, you can take advantage of such programs where you know that for sure that if you are able to disclose your tax arrears to the government, then the government is able to do away with the interest and penalty that accrues to such taxes. So we can also talk about what we call financing. We talk about financing. When you talk about financing, in terms of financing, a company can basically decide to finance. Using a loan or through shares. But we basically say that the cost of shares, which is dividend, is what we call a non-allowable expense. However, if a company decides to finance using what we call loans, then the government definitely is going to get what we call interest that are accruable to loan that are allowable deduction. That interest that basically accrue from a loan is what we call allowable deductions. Again, a company could also have options, whether to lease or to buy an asset. But you're saying that a company in this case should basically do what? A company should basically buy an asset. Because through buying an asset, a company is able to claim what we call investment allowance. A company is able to claim what we call investment allowance. Then we can also talk about a company's tax opportunity that are available to in decisions of a company. We can also talk about companies that are located in EPZ, that is export processing zones. We know that for the first 10 years, they're basically exempted. They're basically exempted from tax. Those companies that are located under EPZ, those are the export processing zones. For the first years, for the first 10 years, they're basically exempted from tax. But you also know that in the 11th year for these companies, they are taxed at a lower rate of 25%. Then we can also talk about charitable donation. When you donate to charitable organizations, we say that charitable organizations that have exemption certificate, then those ones you can reduce them to reduce your taxable income, because donation to a charitable organization is what you call allowable deduction. So we can put one, you say donation to charitable organization, donations to what you call charitable organization, where we're saying that donation to charitable organization, donation to charitable organizations that holds exemption certificate, donation to what you call a charitable organization that hold the tax exemption certificate are tax deductible, are what you call tax deductible. So those who understand this take advantage of this, because if you donate to charitable organization that basically holds that holds exemption certificate, we know that donation would be treated as a tax deductible, or what you call allowable deduction. So we say that decision number 2, decision to buy an asset or lease. A decision whether to buy an asset or lease. Decision whether to buy an asset or lease. So we can say, well, if a company should buy an asset instead of leasing, since they can claim what you call investment allowance. They can claim what you call investment allowance, which is allowable, allowable expense. They can claim investment allowance, which is basically allowable expense, since they can claim investment allowance, which is treated as allowable deduction. We can talk about, especially voluntary. This program basically is not there, but it was a voluntary disclosure programs. Voluntary disclosure programs. At this particular time, we had such programs, what we call tax VDT, voluntary tax disclosure program, where if a taxpayer, that is a company, disclosed the taxes that they had not paid, then they would be given waiver. On interest and penalty. This is basically designed in order to assist the taxpayer, in this case the company taxpayer, to reduce taxes, interest, and penalty that accrue on taxes in arrears. When you talk about taxes in arrears, these are basically taxes that are not paid particularly on due date. So that would definitely assist on that. Then we talk about investing. We can talk about investing, holding more than 12.5% shares of another company. So when a company decides to hold more than 12.5% of the shares of another company, we know that interest basically that accrue from such dividends that accrue are exempted. Dividends, we say that dividends where a company holds, we say holds more than 12.5% or more of the shares are exempted. We know exempted from tax. So we say that holding more than 12.5% or more, we talk about holding more than 12%, 12% or more, or just say more than 12% of shares, 12.5% of shares of another company. Dividends where a company hold more than 12% or more, 12.5% or more are exempted. We say 12% or more. Dividends where a company hold 12.5% or more of the shares, Dividends where a company hold 12.5% or more of the shares are, we say, exempted from tax. Are basically exempted from tax. So a company basically is able to reduce what you call the tax liability. A company is able to reduce what you call a tax liability. So we can talk about in investing. We have investing in EPZ. EPZ is what you call export processing zone. So what are those benefit or incentives that are available to a company that invest in a EPZ? Tax holiday. We know tax holiday. We talk about tax holiday for the first 10 years. For the first 10 years, the company basically is given a tax holiday. For the first 10 years, we know that a company would definitely then a tax rate. We talk about tax rate of 25% from what you call the 11th year. So a company will be given a tax rate which is much lower than the normal from the 11th year, basically granted a tax rate of 25% from the 11th year. So those are basically five. We've talked about the decision to buy an asset or lease. We have talked about donation to charitable organization. We've talked about the voluntary tax disclosure programs, where a company would be given the liability of the interest and penalties would be taken off. We've talked about holding more than 12% of the shares of another company. So dividends where a company holds 12.5% or more of the shares are exempted from tax. Then we talked about investing in EPZ, where we say that granted tax holiday for the first 10 years. And we also know that The tax rate is 25% basically on the 11th year. The tax rate is basically 25% on the 11th year. Again, also financing. We talked about financing, financing. Whether we can talk about whether to finance through loans or shares. Whether to finance through loan or shares. Then you say a company should finance through loans since interest on loan is allowable expense, whereas dividends, which is the cost of shares, is not allowable expense. So if a company basically has options either to finance through loan or to finance basically through shares, then the company should basically go for loans. Because why that? Because interest that accrue from a loan is allowable deduction, whereas the cost, whereas dividends, which is the cost of shares, whereas dividends, which is the cost of shares, is not what you call allowable expense. Dividends, which is the cost of shares, is not basically allowable expense, is not basically allowable expense. So these are some of the available tax opportunities that are available for a company. That is how we basically tackle that question on tax planning opportunities for the company. December 2024, question 5A. And 5A, there's Roman 1 and there's Roman 2. Roman 1 and there's Roman 2. So I want us to pick in the first one, that is Roman 1. We read the question. So on Roman 1, the examiner tells us that we start with the first one, in general, then we have Roman 1 and 2. The taxation of capital gain in Kenya represents significant shift in a country's tax, represents a significant shift in the country's tax policy. While its reintroduction has increased government revenue, and aligned Kenya with international practice, it also presents challenges. Hence, ongoing improvement and adjustment in administration is crucial for optimizing the benefit of capital gain while minimizing its drawback. So analyze two circumstances that constitute transfer of property for purpose of computing capital gain, and number, that is Roman 1, two challenges encountered in administration of capital gain. So there are two scenarios that are presented here. On the inception, there is a point that the capital gain tax was dropped. That was basically for many people to own property. Again, there was reintroduction, and we're saying that with the reintroduction of capital gain tax, it has come with what you call challenges. It has basically come with what you call challenges. So the first question, we're being told that circumstances that constitute a capital gain. So that is Roman 1. One circumstance that will constitute a capital gain, we call it when a property is sold. Number one is when a property, we call it when a property is sold. When a property is sold, that is either conveyed as a gift, Number one, conveyed as a gift or otherwise, or we say otherwise, otherwise disposed, we say disposed of, otherwise disposed of, in any manner, otherwise disposed of in any manner, by way of gift, by way of what we call gift, otherwise disposed on, conveyed, sold or conveyed, or otherwise disposed of, conveyed, or otherwise disposed of in a manner as a way of gift, whether or not for consideration, So when a property is sold, or conveyed in a manner as a way of gift, that will constitute capital gain. The number two, that would constitute capital gain. On the abandonment, we'll say on the abandonment, on what we call abandonment, surrender, we have cancellation, or what we call forfeiture, surrender or forfeiture, or forfeiture of, or what we call the expiration of substantially expiration of some substantially all rights to property. What are we trying to say? We say including what? Including the surrender of shares. So we have CGT1, CGT2, and CGT3. So when you surrender shares or debenture, that will also constitute what we call a capital gain. When you surrender shares or debenture, and that's why we classify the capital gain taxation. We have the CGT1 that is transferred by individuals. We also have 2 and 3, where we also will include shares and debenture on dissolution of a company, on what we call the dissolution, dissolution of what we call a company. When a company is brought to an end, that will constitute a capital gain. We can add one as a way of just, the examiner needed 2, but he had 1 as a way of having an extra. On occasions, we say on what we call the occasion, on the occasion of loss, we have destruction, or extinction, or what we call extinction, or what we call the extinction of property, we say whether extinction of property, we stop using extinction of property, whether or not a sum, we'll say whether or not a sum, by way of compensation, whether or not a sum by way of compensation is received, we say is received in respect, we say is received in respect, we say that in respect of the loss, destruction, or extinction, whether some compensation is received in respect of the loss, destruction, or extinction, unless that is a negation, unless unless is used to reinstate, to bring it back if there's a loss, to reinstate what you call the property, unless that amount received is basically used to reinstate the property, reinstate, or to bring back the property to the position where it was. It is not received and gotten, but that amount is basically received to reinstate, to basically bring the property back to the position, to reinstate the property. Especially, this is especially, we'll call it especially, the same farm, especially what you call the same farm, and in the same place, the same farm and in the same place within 1 year, within 1 year, basically within 1 year, or within a longer period, or within a longer period. We say approved by the commissioner, approved by what you call the commissioner. So we emphasize on what you've done. We say that number one, you talked about, as a background information, that when you talk about capital gain, initially capital gain was there, but then withheld. It was no longer charged as a way of encouraging people to own property. But with the reintroduction of the capital gain, we say that they came up with challenges to the capital gain. But the very first question that is on A, we are being asked that which transaction would basically constitute what we call a capital gain. One, we say when a property is sold. We say convey or otherwise dispose of in a manner by which, by way of gift, or whether or not for consideration, that will constitute what we call a capital gain. And number two, we talked about on abandonment or surrender, so cancellation or forfeiture of, or the expiration of substantial all right of property, including surrender of shares or debenture on dissolution. So that will also constitute a capital gain. And exactly I talked about, when you talk about this, we have various types of CGT. We have CGT1, CGT2, and CGT3 there talks about transfer of shares, that is also constitute a capital gain. Then we have the third one as an additional one. We talked about occasion of loss or destruction, or what we call extinction of property, whether or not some by way of compensation is received in respect of the loss or destruction, unless is used to reinstate. When the amount is basically used to reinstate by the same farm in the same place within a year, that will not constitute. So that those three transactions basically will constitute what we call a capital gain. So then we go to what we call challenges. That is Roman 2. The examiner asks for what we call, explain two challenges encountered in administration of capital gain tax in your countries. We say that with the reintroduction of the capital gain, basically there were challenges that it basically came up with. What are these challenges that came up with reintroduction? Lack of compliance, lack of what we call compliance, and record keeping, by what we call by taxpayers. Yes, a number of people. One of the challenges that came with it is lack of compliance, people being compliant, and record keeping by taxpayers. Thus, when you say thus, we say thus complicating. So this is 5A Roman 2. 5A Roman 2, just to 5A Roman 1, just to differentiate that. So we have lack of compliance and record keeping by taxpayers. That's complicating. We say that's complicating the tax, what we call the tax reporting, process, and what we call increasing and increasing risks, and increasing risks, or errors, or what we call the tax evasion. Tax evasion, where records are increasing what we call tax evasion, increasing tax evasion. So the second, we have what we call complexity of tax, complexity of what we call tax rules and laws. Complexity of tax rules and laws governing what we call the capital gain tax. Complexity of the tax rules and regulation that governs the tax, the capital gain tax, making it making it difficult. We know that making it difficult to navigate, hence making it difficult to navigate the complexity, thus leading to what we call to misunderstanding. Thus leading to what we call the misunderstanding. Thus leading to the misunderstanding as a result of tax rules becoming complex, people misunderstanding, and incorrect tax filing. And incorrect, very important, incorrect tax filing. Incorrect tax filing. So that is the second challenge that basically emanated. So we can have capital gain, last one, capital gain tax influences what you call investment. Investment. We know that transfer of property influence what you call investment decision, and influences investment decision and market behavior, and what you call and market behavior influences investment decision and what you call market behavior. This leads to, when it's high, for example, when the capital gain tax is high, it basically reduces investment. This reduces. See, this leads to reduced investment and tax avoidance because capital gain is basically on property, so very key. It influences investment. When the rate is essentially very high, what you know that investment level will go down. With together investment level would technically be at a lower level. So that is how basically we handle that question. The question 5, Roman A.
Greetings, candidates, and welcome to the lesson. Today we are going to review selection of public funds in Kenya. The subtopic is review of selected public funds in Kenya. The topic is the role of accounting officers in management of public funds. And in this lesson, we'll be analyzing a few of the many public funds in Kenya. And the Kenya's public finance system, we know, operates through various established funds, each with a specific purpose for managing public money. And key among these and established by the Constitution are the Consolidated Fund, the Equalization Fund, and so on. So the Public Finance Management Act further details their operation and provides for the establishment of other national and county government public funds, such as the contingencies fund, the county revenue funds, and so on. In this lesson, we will highlight just a few of the public funds in Kenya, beginning with the main fund, which is the Consolidated Fund. This is the principal public fund in Kenya, and it is established by Article 206 of the Constitution. Article 206 of the Constitution establishes the Consolidated Fund. The Consolidated Fund established under Article 206. The Consolidated Fund is the principal national government public fund. It is the principal national government public fund, and its primary purpose is to receive all money raised or received on behalf of the national government, unless otherwise provided by law. So all the money that is received by the government has to be deposited in the Consolidated Fund, and this includes tax revenues, non-tax revenues, grants, proceeds from national government borrowing, and so on. That is the purpose. The purpose is to receive all money received by the government. Purpose. The purpose of the Consolidated Fund, I repeat, is to receive all money raised or received by or on behalf of the government. It is to receive all money raised or received on behalf of the government. That is the primary purpose of the Consolidated Fund. And this includes the tax revenues and non-tax revenues, and also proceeds from national government borrowing. Financing. How is this fund financed? Financing. Now, the Consolidated Fund is financed by all national government revenues, including taxes collected by the Kenya Revenue Authority, fees, fines, grants from development partners, proceeds from domestic international borrowing, and so on. Right? That is how, that is the source of financing for this Consolidated Fund. Taxes, grants, proceeds from borrowing, domestic borrowing, foreign borrowing, and so on. That is financing. How about operationalization? Operationalization. Now, money can only be withdrawn from the Consolidated Fund in accordance with an appropriation by an Act of Parliament. That is the Annual Appropriation Act or Supplementary Appropriation Acts. Money can only be withdrawn from this fund in accordance with an appropriation by an Act of Parliament. Appropriation Act. And supplementary acts. That's the only way money can be withdrawn from this account. Okay? supplementary appropriation acts in accordance with specific constitutional provisions. For example, if there is urgent expenditure or as a charge against the fund authorized by the Constitution or legislation. So all withdrawals, furthermore, candidates must be approved by the Controller of Budget. All withdrawals from the consolidated fund must be approved by the Controller of Budget. Approval is necessary by the Controller of Budget. We are studying operationalization. Withdrawals must be approved by the Controller of Budget in order to ensure they are lawful and in line with approved budget. And the National Treasury administers the consolidated fund. The National Treasury administers this fund. It is the National Treasury that administers the consolidated fund and is responsible for its overall management, including maintaining accounts at the Central Bank of Kenya and managing cash flow. That is the consolidated fund. We've highlighted the purpose, how it is financed, and how it is operated. Let's move to the second fund. The second fund is the Equalization Fund. Equalization Fund is another fund in Kenya, which is established by Article 204. Article 204. This one we said is Article 206. Equalization Fund is established by Article 204 of the Kenyan Constitution and is specifically created to provide basic services, including roads, health facilities, electricity to marginalized areas, to provide services, marginalized areas. Purpose is to provide services to marginalized areas. Services like electricity, water, and so on. Okay, it's to bring the quality of those services to the level generally enjoyed by the rest of the nation. So in marginalized areas, we find that the quality of life is not as other areas in the nation. So there is an equalization account, a fund that is created by Article 204, and the purpose is to provide services to such marginalized areas so that the quality of life is the same as other areas in the nation. How is this fund financed? Financing. Now the fund is financed by 1.5% of all revenue collected by the national government. 0.5%, which is 0.5%. 0.5% of all the revenue collected by the national government each year, of revenue collected by the national government each year. So out of all the money that the national government collects each year, 0.5% is set aside for the Equalization Fund. For the Equalization Fund, all right, as approved by the it is 0.5% of all revenue collected by the national government each year, calculated based on the most recent audited accounts of revenue received as approved by the National Assembly. And any unspent money in the fund at the end of the financial year remains in the fund for use in subsequent years. Remains for use in subsequent years. Operationalization. Operationalization. Now, the national government utilizes the equalization fund, but only to the extent that the expenditure has been approved in an appropriation bill enacted by Parliament. Okay? And the funds can be used either directly by the national government or indirectly through conditional grants to counties with marginalized areas. So the Commission on Revenue Allocation is required to be consulted and its recommendations considered before Parliament passes any bill appropriating money from the fund. And withdrawals from the fund must also be approved by the Controller of Budget. Must be approved by the Controller of Budget. That is how the fund is operationalized. Okay? The national government utilizes the equalization fund, but only to the extent that expenditure has been approved in an appropriation bill. Appropriation bill. There has to be an appropriation bill. An appropriation bill enacted by Parliament, and the funds can be used either directly by the national government or indirectly through conditional grants to counties. So the national government can send money to counties that have marginalized areas. So the money can be spent directly or through conditional grants. Through conditional grants. And before money is withdrawn from this fund, the approval of the Controller of Budget must be sought. Funds must also be approved by the Controller. Withdrawals, approval by the Controller of Budget. Controller of Budget. And the Public Finance Management Act and the Public Finance Management Equalization Fund Administration Regulations provide the framework for its administration and management, including establishment of an advisory board. An advisory board. So that is the equalization fund. The third fund is number 3. Apart from the consolidated fund and the equalization fund, we have the contingencies fund. Contingencies. The contingencies fund. What is the purpose of this fund? What is the purpose of the contingencies fund? Now, first of all, the contingencies fund is established under Article 208 of the Kenyan Constitution, and this fund is intended to cater for urgent and unforeseen national expenditure. To cater for urgent and unforeseen expenditures like disasters, droughts, and so on, for which there is no other legislative authority. So the fund allows the government to respond to emergencies or unforeseen events that require immediate funding before a supplementary budget can be approved by Parliament. Financing. How is the fund financed? The fund is financed through appropriations by Parliament. It's through appropriations by the National Assembly. Through appropriations by the National Assembly as provided for in an Act of Parliament. Operationalization. Now, an Act of Parliament provides for advances from contingencies fund. Act of Parliament. Act of Parliament. There has to be an Act of Parliament. An Act of Parliament provides for advances from the contingencies fund if the Cabinet Secretary for Finance is satisfied that there is an urgent and unforeseen need for expenditure for which there is no any other authority. So the Cabinet Secretary administers the fund, but withdrawals require parliamentary approval. National Treasury administers the fund, but withdrawals require parliamentary approval. Parliament must approve any withdrawals from the fund, from the contingencies fund. From the contingencies fund. Parliament has to approve. All right? Parliament has to approve any withdrawals from the contingencies fund. So the Cabinet Secretary have said of National Treasury administers the fund, but withdrawals require parliamentary approval, which is done usually retrospectively through a supplementary budget, because remember, this is executed when there are emergencies. So Parliament may not be in session to approve before the money is spent on emergencies. And again, there has to be approval of the controller of budget. Approval. Withdrawals must be approved by controller of budget. Controller of budget. So these are 3 funds. You can go on and mention the fourth one, D. The fourth fund is the County Revenue Fund. County Revenue. The County Revenue Fund. Now, what is the purpose of the County Revenue Fund? Before the purpose, this one is established under Article 207. 207 establishes the County Revenue Fund for each county government. And for each county government, the County Revenue Fund is the principal fund for receiving all money raised or received by or on behalf of the county government, unless otherwise excluded by legislation. How is this fund funded? Financing. How is it financed? Financing of County Revenue Fund. Now, county revenue funds are primarily financed by equitable share of revenue. By equitable share of revenue. They are financed by equitable share of revenue, by equitable share of revenue raised nationally and transferred from the consolidated fund, and also the county's own source revenue and county's own source revenue. County's own source revenue also is used to finance the county revenue fund. You understand? Money from property rates, business permits, fees, and charges are used to finance the fund. And they may also receive grants from the national government or other sources and proceeds from authorized county government borrowing. As for operationalization candidates, the money can only be withdrawn from county revenue fund in accordance with an appropriation by a county appropriation act or as otherwise authorized by law. And again, withdrawals must be approved by the controller of budget, and the county treasury is responsible for the administration and management of county revenue fund, including maintaining of accounts and also managing cash flows. Managing cash flows. That is how it is operationalized. So these are 4 public funds. We have also other funds. Apart from these 4, there are other funds. We have many other funds, many other public funds. The Public Finance Management Act allows for the establishment of other national and county government funds through legislation for specific purposes. Other public funds can be established through legislation for specific purposes. And these funds are financed and operationalized as specified in the respective legislation that creates them. One example is the National Drought Emergency Fund. National, there are so many candidates. I may not be able to list all of them, but we have the National Drought Emergency Fund, which is established under the Public Finance Management Act, and it aims to mobilize resources for efficient and effective drought management in Kenya, including preparedness, mitigation, response, and recovery. This fund is financed through appropriations by the National Assembly through grants, donations, and other lawful sources. So there are many funds like the Rural Electrification Program Fund, the Tourism Fund, Sports, Arts, and Social Development Fund. We have the Roads Maintenance Levy Fund. We have the Women Enterprise Fund, the Hustler Fund, and so many other funds that are enacted through legislation. So that's all for today's lesson, where we have reviewed a selection of a few public funds. That is, number 1, the Consolidated Fund, which is established by Article 206. Number 2, we have the Equalization Fund, as established by Article 204 of the Kenya Constitution. Number 3, we have the Contingency Fund, established by Article 208. Number 4, there is the County Revenue Fund, Article 207. Then we have other funds which the Public Finance Management Act allows. The Act allows for the establishment of other national and county government public funds through legislation for specific purposes. We have almost every government ministry, there are funds that have been created. They will have one for water, for electricity, for transport, for sports, and so on. So thank you for attending the lesson. We will, in our next session, continue to share knowledge in public financial management. Bye-bye. Hello, candidates. Welcome back to the public taxation learning session. We're still on the first